So it's safe to say overall the market now in a bit of a pullback. We're going to talk about in this video timing the market, guys, versus time in the market. You might have heard the term dollar cost averaging. We're going to discuss exactly what that is and what that means and how you can get an average over time instead of pushing all your chips into the center of the table all at the same time. Slow and steady may in fact win the race over time. And yeah, number 3 there, stock picking is not easy, guys. Let's jump into this topic because it's an interesting one. Talking about, if you're a long-term investor and your time frame is months and years down the road, you're not really concerned about little fluctuations in the overall market. Time in the market is the best way to go.
Exactly, Brandon. You want your money to compound. You want to take advantage of all of the biggest moves. And the truth of the matter is, simply holding on to the broad market's what's going to get you there. Now, I'm not going to pull back and show you all the way into like 1950. I could with the SPY, if that's what you really wanted to do. But I kind of wanted to highlight, after the great bounce that we had off of 2008, there was almost a full year run where the SPY was absolutely flat. And if you had said, okay, I should sell in front of this resistance that entire year, you would have absolutely been right. I mean, it would have been dead money. There were some pullbacks. But here's the issue with that. At the end of the day, if you pull money out of the market and sell at an absolute high, that's great that you've managed to time it in that fashion. But you don't take advantage of the breakout that then happened from 2016 to now. And again, this is about a 50% run from when we broke that 200 area. You don't take advantage of that if you don't get that money back in, right? So it's one thing to be able to pick resistance, and after it's bounced here a few times and you get the market sentiment that things are flat, you got to get your money back in. And it's not always that simple to do so. And I think that's the biggest thing that we have to talk about here, because if you don't accurately pick this pullback, 15% pullback, and don't get your money back into the market, well, then you're more of a sucker, and simply selling there's not a genius move at all. All you've done is thrown away potential profit. At the end of the day, the markets rise. That's what they've done historically. And if you do find a way to pick that top, you've got to find a way to get back into it. And sometimes trying to be perfect on the way back in is just going to hurt you in the long run.
Yeah, look, just do time in the market. You're going to look at fundamentals. You're going to try to pick stocks that you believe in, and you're not super worried about looking at price movement or price action on the chart. And I think that helps a lot, because what time in the market does is take away the emotion, right? Like, you have a day like today maybe where you come in and you're down 2% on the NASDAQ and you say, oh, I got to sell everything. Why don't we go to my chart there, Lucas, if we can? DraftKings, I think, is a perfect example. I mean, look at the roller coaster ride you would have here on DraftKings, like up and down and around and up and down and around. Like, God forbid you like the name down here somewhere and you get in kind of early, $38, $39, and all of a sudden, it goes all the way up, and then as it's coming back down, you're like, oh no, I got to sell, like I don't want to turn all this profit away, and then you get out, and then you watch it go right back to the upside again. If nothing's fundamentally changed, then you might as well stick to some of these names. So time in the market takes away that whole decision making. You don't have to get out until something fundamentally changes. And when that happens, then you look to say, okay, now what are my price levels? But I would say time in the market helps take away from stock picking. You just have to make one decision and sort of stick with it. But when you do get those peaks and valleys, sometimes it's good to look at those to make your ins and outs as well.
So taking that entire amount that you want to get eventually into the market, dividing it up over, say, a 12-month period or a 24-month period, and putting the same amount into the market, regardless of the instrument, each month, over time, will end up with a better average price, guys. That is the moral of the story. Hope that helps when it comes to time in the market versus timing the market. Here's Miss V.
Hey guys, thank you for sharing this helpful information. Dear viewers, please subscribe to this channel to see more great videos.